excellent, the prospects have been excellent for some years. Page 42 shows an unsettling pattern that has characterized emerging markets for years. And I've left the names off these graphs deliberately. I just want you to concentrate on the volatility of the moves in here. In the first one, in the upper left-hand corner, a very rapid 1 month rise from about 1,000 points, from 400 on this graph up to 1,400, then a slightly slower 5 month decline that wiped out the entire advance. Then you had after that a 3 month rise of about 275%, and then the market gave it all back over the next 17 months. So obviously, tremendous volatility. You see the same patterns with different numbers as you go through here. 475% rally over about 7 years, gave back about 75 or 70% of that over a period of 5 years. Down here, you have about a 500% rally in a little over 2 years, and then you lost about 80% of it in a little over 1 year, and then finally about a 50% rally, and then you gave back about 70% of that rally over 11 months. Now, I didn't want to put the names on it, but all of the graphs make up the graph you see on the next page. It's China. Those 4 separate pieces are what you see on page 43. We've just broken them up into different segments to emphasize the volatility. It's instructive at a little under 3,000. Prices are obviously well up from where they were almost 20 years ago down here, but they are certainly way down, over 50% down from where they were just at the market top in 2007. And it's instructive to note that prices in 2005, right here, were below where they were in 1992. Now, China didn't become an emerging country just in the last 5 years. It was well emerging in here. Their markets are dangerous markets at times. That's not to say they won't be monumentally successful in years to come, but it is important, and I carry this thought to more than just China. China just happens to be the one we hear the most about. These are very volatile markets, and they're great in bull market periods. If things don't go extremely well, they can be very dangerous. And any market that rallies and declines in the manner observed there over the past 2 decades is clearly a mania-driven type index. And almost all analysts we hear are bullish in China. Yet the stock market is down 50% from where it was just 3 years ago. And there's no telling why prices are as low as they are. Some commentators speculate that there's a Chinese housing bubble forming. Others, myself included, are worried about the condition of the Chinese banks. We warned about Japanese banks in the 1980s. We warned about US banks in this past decade. And I would warn people about Chinese banks now. If you look over to the next page, well, before I get to that even, it's hard to imagine a centrally planned economy, and China is clearly a centrally planned economy, which has encouraged frenzied lending at any number of spots along the last several years. It's hard to imagine that they will escape the problems that banks in more developed countries have experienced over more recent years. It's especially surprising when one thinks of this as an emerging country, where the banks don't have a long history of tried and true success. They're going through a lot of this stuff for the first time. For them to have great success with no real upheavals is a stretch. Here you have China's sales strong but slowing. This is still well above 50, which is down here. China, this is still growing up here. It's just the trend has started down. It's growing at an increasingly slower rate of improvement. 59, which is its latest number, is certainly not contracting. To my way of thinking, it's a long shot to count on emerging countries leading and supporting a world economy, however. If the developed countries don't get their act together and perhaps with this additional stimulus come bouncing back, it's going to be very hard, I think, for the emerging economies for the first time ever to lead the world to higher levels. Let me turn at the end here to fixed income. Bond yields are near historic lows. What we're looking at on this page is the yield on the 10-year Treasury bond starting in the 1970s. And you see the peak in the early 1980s up here in the 15s. And then where we are today, I think it closed today at 245. That was the 2.45%. And there have been quite a few multi-year rises and falls in the interest rate as we've gone through this 3-decade period of declining rates. And there's no way to know where the bottom actually will finally prove to be. But we know at something under 2.5%, we're a heck of a lot closer to the bottom than we are to where things were just several years ago. And page 46, the next page, shows that we've had only three major bond interest rate cycles over the better part of the last century. Rates declining from about 1915 into the 1940s, rising to the early 1980s, and falling since then. This is AAA bond yields, whereas on the past graph I was looking at 10-year U.S. Treasuries. Page 47 shows the consequences to bondholders in the last long interest rate upcycle. And this I point out because, as I say, I don't know where the bottom is, but at 2.45, somewhere before too long, we're going to see rates start going up. Maybe a year, maybe 2 years, might be next week. But when it does, you see what happened in the 41 years here. I'll say a broad cross-section of bonds, intermediate governments, long-term corporates, long-term governments, might have gotten you at best 3% per year. Unmanaged cash was 3.6, and inflation was 4.7. You lost purchasing power in bonds for 4 decades. I'm looking again at a broad cross-section here. Now, obviously, the history of the last 30-some years has been exactly the opposite. We've been in a virtuous bond cycle. And it's not going to be as easy, it can't be as easy, with coupons down as low as they are today. Cash beat bonds, if you look at, say, managed cash here, managed cash beat bonds on average probably by about 1% per year over that full aggregate of 40-plus years. Next page shows the fear affecting a great many investors. This is the 3-month Treasury bill rate. You can see how it's fluctuated from the late 80s down here. Here's where the Fed held it under 2% for about 3 years, which fueled the real estate bubble. And now, of course, we're 2+ years or so into effectively zero rates on short-term Treasury bills. This is at about just over 0.1% per year is what people are willing to give the money to the government for and get back for giving them, for making that loan for 3 months. It's a minimal amount, but it really shows the desire to have return of the capital more than the worry about return on the capital. I'm going to skip over the next page and go over to page 50. It shows an interesting and insightful comparison of the stock and bond markets by David Rosenberg, who was the chief North American economist at Merrill Lynch for many years and is now with